Well, I think what we see more and more of is companies trying to avoid risk and to maximize profits, and they're in the business to make profit. So that there's nothing criminally wrong with that. But I wish we could get back to a philosophy of insurance being managing risk and not just trying to avoid risk.
To understand why the industry changed, you need to look back to 1992. That's when Hurricane Andrew slammed into South Florida and completely shook up the industry. Insurance companies lost $12 billion that year, and they couldn't afford to let that happen again. So they hired consultants, bought reinsurance to cover their own losses, and they began cracking down on their own customers.
Some things they're doing are legitimate. They're buying more reinsurance, but some of them are not so legitimate. The insurance industry was genuinely shocked by Hurricane Andrew.
Robert Hunter has worked in the insurance industry for more than 40 years as an adjuster, Texas State Insurance Commissioner, administrator of the Federal Insurance Agency, and now as insurance director for the Consumer Federation of America.
There are hidden deductibles that relate to wind that are now different than the deductible you negotiated. They have caps on replacement costs. Then there are other limits where payments won't be made. For example, there are exclusions now on mold. They used to cover if you had to do something to meet building code because of the damage. They've excluded that now.
And he says they came up with an exclusion known as anti-concurrent causation. Anti-concurrent causation, which is what?
Sounds pretty awful, doesn't it? And it is. It says if two events happen, and one is covered in your policy, and the other is not, and they happen at about the same time, and it doesn't matter which one happens first, we don't cover either.
Hunter says the clause is being abused by insurers.
Big example is Hurricane Katrina, where you had wind and flood. And so the wind battered houses, roofs flew off, and so on. Then along came a storm surge and wiped out the rest of the house. People got nothing because the flood, it wasn't covered.
Hunter estimates as many as half of American homeowners don't have adequate insurance. And while the industry says that's usually the fault of homeowners not keeping their policies up to date, that doesn't explain the case of Karen Remus. Not only did the company refuse to pay her policy limit, but it turned out the limit itself was too low.
We had a brand new policy, and not only did we have extended replacement, we bought the earthquake rider. I mean, we did everything we possibly could to be properly insured.
So when the insurance industry says that this whole issue of underinsurance is really the insured's fault, what does your experience tell you about that?
I didn't pick the number in the policy. They did. They used their cost valuation software, their program, and they came up with a number. You know, when I go to the dentist, I don't say, oh, are you sure that's a cavity? I went to an insurance professional. I thought, okay, they know what they're doing.
The insurance industry's changing strategy is paying off. In 1992, the year of Hurricane Andrew, for every dollar the companies took in premiums, they paid out $1.27 to settle claims. By 2005, the year of Katrina, they got that number down to less than 72 cents. In fact, according to AM Best, the authoritative source on insurance industry data, homeowners insurance has been a consistent moneymaker since 2003. According to industry estimates, it even earned record profits in 2006 and 2007. And some insurance companies leave little doubt about how they did it. The nation's largest insurer, Allstate, wrote to investors last year that its strategy includes removing wind coverage from certain policies, changes in rates, deductibles, and coverage, even discontinuing coverage for some types of homes. Chubb Insurance credited contract wording changes related to mold coverage and other loss remediation measures for its rising profits. Robert Hartwig is the president of the Insurance Information Institute, which speaks for the industry.
Insurers can be very proud of their performance, both in the wake of major disasters across the country, whether it's Hurricane Katrina or the California wildfires, or on any given day of the week.
To what extent are those profits coming at the expense of policyholders and their coverage?
There's no inconsistency between the profits insurers are generating and the level of coverage and service that customers are getting.
One of the things that we've heard a lot about, and that regulators and others tell us is becoming more prevalent, is what they call lowballing, where people will file a claim, The scope of loss comes back, and there are things that are missing. Is lowballing a problem?
There is no such thing as lowballing in the homeowners insurance industry.
No such thing.
That's right.
And about all those exclusions, Hartwig claims that where insurance companies have cut coverage, it's been for the homeowner's benefit.
Generally speaking, the homeowner's insurance policy has remained relatively unchanged. But if you have a homeowner's insurance policy that begins to provide coverage for types of losses which were never intended, you ultimately wind up with a premium that is unaffordable to many Americans.
And coverage that's unaffordable for insurance companies to offer and still maintain those record profits. But Hartwig says these good years are necessary to pay for the bad ones.
It is in the consumer's best interest to have an insurance industry that's profitable, financially secure, sound, and stable.
But Hartwig himself says the industry has built up $100 billion in excess capital, well beyond what it needs to cover losses. $100 billion in excess capital.
Well, the insurance industry has built up capital, and so what insurers are doing is returning that capital to shareholders.
In other words, rather than using all that money to beef up coverage, insurers are using the vast majority of it to buy back their own stock.
It doesn't sound like an industry that's saving up for a rainy day.
Well, in fact, the industry has, in fact, done that. The industry has had reasonably good levels of profitability in 2006 and 2007.
Hartwig says the vast majority of homeowners are satisfied. But nearly 5 years after the 2003 wildfires in California, nearly 100 complaints are still unresolved.
Underinsurance.
And Karen Remus is holding insurance seminars for victims of the most recent wildfires.
The whole thing, these current 2007 firestorm issues, it's just a flashback. I mean, it's almost like reliving what happened in 2003. I've been in contact with a lot of 2007 firestorm survivors through my volunteer work. I mean, a lot. And the underinsurance is rampant. It's the same stuff.
Do you want one of these?
And with the insurance industry warning about pressure on profits as the economy slows, Karen Remus hopes that doesn't mean more pressure on homeowners.
Our house had just burned to the ground, and anything and everything we had ever had was gone. They use advertisements that said, if something bad happened, they're going to put me back. And I paid good money for that coverage. I shouldn't have had to fight that hard. And I shouldn't have had to fight at all.
Complaints about the insurance industry have begun to attract the attention of regulators. New York's Attorney General recently stopped companies from canceling policies of some customers living in coastal areas. And in Florida, lawmakers are trying to figure out why homeowners' rates are soaring, even as many insurers are refusing to sell any policy